Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for this special day of Options Guide TV. It's special in that NVIDIA is going to be announcing earnings. Every earnings season, everybody but NVIDIA seems to announce earnings at the very beginning of this quarterly earnings event that we go through. So all of the Meg 7 stocks have announced earnings, but NVIDIA is always on the end, and everybody that is in that Meg 7 gaggle of securities always wants NVIDIA to mention them on their conference call, because one of the biggest things that drives stocks, and this recently happened in Amazon actually, is you just want to say AI. And you want to say that you're doing things in AI. You want to say that you're spending money on AI, that you have things in the pipeline, that you expect this to grow your business. And if you make those statements inside your conference call, it seems that no matter if you beat the numbers or not, that your stock can actually go up. So NVIDIA is very interesting in that if NVIDIA comes out and says that you're buying chips, that usually backs up any comments that you might have made in your conference call around earnings. So it's just a very interesting dynamic that NVIDIA is on the tail end of all of these earnings reports, and they are probably rightfully so, because they just seem to have so much power as far as the markets are concerned. So we're going to look at NVIDIA, but we need to review a few trades that we've already talked about this week. On Monday, we said, well, I should say on Friday, we actually looked at a bearish SPX trade, and we used a modified butterfly to put that on. On Monday, the markets ran up, and we decided that we weren't going to hedge, that we were going to wait a little bit to see if we will hedge our trade. And you might have been able to do that on Tuesday. The markets... The markets aren't going in any one direction at this point in time. We've had the surge up and got a little bit overbought after the election. There was a euphoric response to just the fact that, in my opinion, that the election was over with. We saw the VIX index come back down precipitously down below towards the 15 level. And now we're actually seeing the VIX creep back up, a little bit more nervousness about the markets in general. And we see the VIX right now at 1821. So in this instance, they're worried about I think the biggest concern is what's going on with the 10-year. The fact that the Fed is cutting rates, but we're seeing the 10-year saying, we don't believe it. And we're not really sure if the Fed, I should say the yield on the 10-year and all the other treasuries actually, is saying, well, we don't believe it. We think that you're not going to continue to cut, and that interest rates, that inflation is still a worry. And because of that, we've seen the markets now get a little bit more choppy going into the year end, and we'll see exactly where we're going. I still feel more bullish than I did before the election, because I do think the known event people can trade around. Obviously, we have some time before the changing of hands in the White House. And so changing of the guard, I guess, would be a better way to say it. So with that said, the SPX actually came back down. The fact that we did not do anything on Monday has turned out positively. We probably still would have been okay from what we see, but I'm going to quickly look at that SPX trade, and then we're going to come back and look at our Amazon trade, and I'm going to propose a hedge in NVIDIA going into earnings. In my mind, NVIDIA, well, it's a little bit more mixed. Now, if I think of Apple, a lot of times Apple has had a tendency over the years after earnings to sell off. Just a general feeling. I don't have any proof. I haven't back tested it. And NVIDIA, I think, is kind of coming into that range, unless they completely blow away the numbers, which they've done a few times and completely surprised the markets over the last, I'll say 3 years. But if they're just kind of normal, people will take an opportunity to sell the stock, and especially after you've had a solid run up, which Nvidia has. I mean, it was choppy this summer, and now it has made a strong move into the end of the year. And yeah, so I'm going to give you a way to kind of hedge your portfolio in Nvidia for a very low price using a butterfly. And not saying that I'm bearish on Nvidia. I'm going to say I'm bullish but nervous. And that's the way that I'm going to approach that today. So let's run to the Tradier Pro software. And let's start by looking at our initial position that we had on in the SPX. And before I start going down this road, I do want to make sure that you know that this is a live show. We're using live markets. If you want to ask any questions about any of the trades, now ideally you would ask about trades that we're talking about today. But if you do have anything else that you would like to address or a different underlying you'd like to talk about, I'm willing to consider it if we don't run out of time. Usually we go about a half hour on Options Guide TV. So here's where we're at in the SPX. And the markets even came down more. Now, when we started the show, we were down 33 in the SPX, and now we're down 40. So we're actually within the range of our strike, and it is Wednesday. So you're going to get a bunch of time decay on this trade. Okay, so interesting enough. Okay, when we first put on the trade in the S&P 500 index, I'm going to pull up my screenshot here. The SPX was trading at about 58.82, and where are we at? 58.77. So we're actually below where the underlying started at. We put this trade on for a net debit of $2.70. We now see that this trade is trading for around $3, and we're dancing around this strike. Okay, so let me set this up a little bit better. I'm just trying to get my bearings, considering the market is hurting right now. With the VIX jumping up to 1823, we obviously have some nervousness in the marketplace. That's a pretty big move on half a point or 0.5% downturn in the S&P 500 index. Okay, so if I look at the what if calculator, let me set up the trade that we had in the S&P 500 index. Let me pull this down, and I'm going to zoom in a little bit here. Okay, so on Friday, we came in and said, well, going into next week, we're looking for a little bit of a down move. The market was at, like I said, 58.82, and we were looking for the market to come down towards 58.55. That would be our middle strike on our trade. Now, this is as of today, saying that if you did the trade for $3, we did it for $2.70. So we're up a little bit on the trade, but we're hanging out right here in this area, and we're in a very nice area and a nice range on the curve. And that as expiration approaches, if you put this trade on right now, here is the profit and loss, this green line that I'm highlighting. Don't look at my numbers bouncing around, but this is where the profit and loss is at right now. But if we grab this and we just move this ahead one day, so this would be 11 o'clock on Thursday, all of a sudden that line jumps quite a bit. And then let's go to 11 o'clock on Friday. And now we got something very interesting that's going on, right, with our S&P 500 index options. Now, as expiration approaches, and this kind of highlights that from 11 o'clock on Friday in the SPX until the close, this green line has to morph towards the expiration graph. All the time premium has to come out of those option contracts. And right now, if we look at it, the put option that we have is trading for $25. So in 2 days, the short strike of our butterfly has to go from $25 all the way down to $0 if it remains an out of the money option contract. That's a lot of time decay over a 2-day period. And that's one of the things that is good and bad about the S&P 500 index. If you're doing trades where you're managing time premium, and that's the way I think of a butterfly. Time decay is your friend when you do a butterfly, if you're correct on your forecast. Then you need time decay to happen if you're correct. So if the underlying market comes down this way, it's got to go from this 25 level and it needs to drift on down and basically become zero. If it landed right at 58.55, and if we go back to the what if calculator, then that's a home run on that trade. So that would be, we did it 20 points wide. So the maximum that it could trade for is 2,000 minus the $2.70 that we put on. And that would be our max upside. Now, not looking to try to hit that type of home run. I'm very happy to take profits tomorrow on the trade if you'd like, or even on Friday. If you do want to hang out that long. Now, markets are feeling bearish at this point in time. Now, here's one of the wonderful things about the way we set up the trade is we stopped short on our credit spread. Now, to me, this is a true modified butterfly. It's not like a skip strike where we're trying to get it done for a net credit. But what we're saying is if we land within the strikes, well, we get a little bit of a bonus. But if we blow away to the downside, we can still be profitable on this trade. And so if it goes anywhere below our lowest strike, which is 58.40, this butterfly will be trading for $5. So if you put it on for $2.70 and it's trading for $5, quick math tells me that you would be up $2.30 on the trade, and you don't have to worry about anything. It just goes down this way. We're going to make $2.30 no matter what, if we do get that strong move to the downside. So if the markets continue on down, I don't mind hanging out on this trade, and there's no real reason to close it until it starts coming back towards our middle strike, and then we have our risk this way. So the markets have worked out for us. It was good that we didn't adjust the trade, but if we did adjust the trade, we would still be looking at the 58.55 level. We would still be quite a bit out of the money because that's where our short put spread would have been, from 58.55 down to 58.40. All right. And if that was confusing for you, then you got to go back and look at the Monday show. That's simple. All right. As far as the adjustment, not going to go through the adjustment today because we have too much to talk about. Now on Amazon, we looked at doing, let me grab the Amazon trade here real quick. Like, on Amazon, we went out and we did a short put vertical. We just wanted to get a little bit bullish on Amazon. And we saw that the market ran up and it came back down and there was a level of support. So we looked at just selling a short put spread. The underlying market was at 203 at the time. And let's see if we're hurting on this one. My computer is froze for the second. There we go. So we're at 201.09. So the support is still kind of supporting on the downside. So right around the 200 level is where there's a level of support. We put the trade on for 85 cents on our short put spread, and we sold the 192.50 and we bought the 187. Is that, maybe it was 190. Let's go look at what the chart says. So just stay the course in the Amazon trade right now. We are going out to the 20th of December, and yeah, right around here is a decent level of support, and then we got another level of support right around the 190 level in this instance. So hopefully we get a little bit of a bounce off of the 20-day moving average right here, and Amazon can stay strong and stay within this range. All right. So that's not doing bad relative to the market. Next off, any questions on those two trades right now? All right, I don't see any questions. If you are in the Tradier hub, which is hub.tradier.com, and you log in, you can ask questions. If you are on x.com, you can follow the show via my handle, which is @BrianOverby, and also inside the Tradier x.com profile. And you can ask questions via x.com. And then lastly, if you are in YouTube and you are logged into your profile, you can go to the Tradier YouTube channel and you can ask questions that way via the chat box. And now let's go in and look at NVIDIA. And here's, if you want to get bullish on NVIDIA, you want to trade NVIDIA, that's fine. Feel free to adjust this trade the opposite direction. But I do want to highlight one little thing that's kind of fun. In the Tradier Pro software, they now are highlighting just a little bit of a small upgrade, the earnings date. And if you put your cursor over the expiration, it will highlight that there are earnings and it will show you the date. Now, NVIDIA it's highly known. I don't think you really need the earnings date highlighted. It's highly known that they're going to be announcing today after the close. I'm going to look at the November 22nd. So we have announcement tonight, and then we have all day Thursday and all day Friday for this trade to live. You may want to go out to the 9th. NVIDIA, it doesn't necessarily just pick a direction after earnings. It's a little bit more choppy. I've seen more than once that the stock sells off on the earnings and then starts a few days later going strong to the upside. So in this instance, I'm going to, my trade today is just going to be a short-term trade, and it's going to be a protective trade, pretending that you have 100 shares of NVIDIA in your account. And if you do, this is the way that I would protect this trade, and I don't want to spend a lot of money on it. So right now, if we're looking at NVIDIA, it's a $144 stock, and if you have 100 shares at this point in time, you're looking at $14,400. That is the amount of the 100 shares that's in your account. So you would multiply this by the number of shares. If you have 200 shares, then you're going to do 2 butterflies. If you have 300 shares, you're going to do 3 butterflies. Now, you can do the put spread, but that's kind of boring. I'm going to look at the butterfly. I think that's a little bit more interesting, and it's a little bit more cost effective. So here's our trade. I'm going to run over to the 1F calculator. I'm going to click on NVIDIA long put butterfly. I'm going to slide this up. I'm going to make sure these boxes are checked, and then I'm going to send it to the ticket. And when I do that, if I jump back to trading, you will see that the butterfly magically appears. Now, quick math, if I look at this and we'll say we're buying the 145 strike, which is exactly where the market is at, that's $6.35. And then we're buying the 145 strike here, that's $6.25. Let's call this $13 approximately. So, well, I guess you could go 13 and you could go 12 and a half if you want. It's not an exact science, but that would be the expected move in NVIDIA going out to the November 22nd expiration. And I want to make sure that I do have the November 22nd expiration up. So we'll call it 12 and a half divided by 145. We're looking at about an 8.5% move is what the marketplace is anticipating could happen to NVIDIA after their earnings announcement. No regard to direction. I always want to highlight that. But I want to bring that into my strategy in that if I am going to put a butterfly together, the expected move is what the marketplace is looking for. So if I want to center my short strike of my butterfly around where the expected move is at. So 145 minus the 1250 puts you at 132.50. All right. So in this instance, we're right around, okay, the market's moved a little bit, 132 here. So let me, I can adjust this if we want to. I don't mind. Let's run. Yeah, this has gone up a little bit. It was a little bit more expensive. So the Nvidia has gone down. So the whole market, there's something that is driving the market quite a bit lower at this point in time. So let's adjust it. Let's adjust it. So we want to make our short strike right around the 132. So let's close this out. So we're going to go down. Yeah, let's go down 2 points on all these. So we're going to clear this. And we're going to be buying. Then I'm going to go 6 points down to the 132. We're going to sell this one twice. And then we're going to stop short on our short spread, and we're going to buy this one once, which is right at the 1 standard deviation move. It's half of the long spread, so it's $3. Yeah, and that's where the trade was at actually when I initially set it up. It's $1.14. So $114 for 1 by 2 by 1 put butterfly that we put on. And that will give us, if it does the expected move, the maximum we could make on the trade is $6. If it landed right at 132 on that expiration date on November 22nd. If it continues on down, to 129. From there beyond, well, we're hurting on our underlying stock, but this trade would still be profitable. We wouldn't lose money on this trade. If we land right in this area, around the 132, it's going to help us out a lot. But if it continues on down and moves more than a 1 standard deviation move, and this is based off of the implied volatility around earnings, well, this trade would still be profitable. This would be worth $3 minus that net debit paid of $1.14. So 3 minus 1.14 equals $1.86. If the market goes up, yeah, we lose that $1.84 on our 100 shares, $1.14. And we have the deductible. Like if it lands somewhere in the middle here, this is probably not going to help us. So from 145 down to 138, this trade doesn't help us out much. From 138 on down, the trade does help us. Ideally, you'd be thinking if the market did open down, we're looking at an expected move right around 132 on this trade. It's not a perfect hedge. And if you are nervous about it, we're getting it on cheap enough so that if you have 100 shares of stock, you can put 2 of these on. You might be able to put 3 of them on. It's all about what you're willing to risk to try to hedge your position. Now, I don't want to go egregious. I don't want to own 100 shares and buy 10 butterflies to hedge, because then you're just flat out bearish on the underlying, and I wouldn't even call it a hedge at that point in time. But if I am thinking just about my 100 shares of Nvidia in my account, and I buy a couple of these at $1.14 divided by $145, we're talking about less than 1%, 0.008 would be the cost of my insurance on a relative basis. So we'll call it 0.5%. And I could buy a couple of these, and I could use this as a little bit of a protective mechanism. And if the market, ideally, if I'm doing this and I'm doing this as a hedge, I want the market to go up. You don't want to be correct that the market may come down and move the expected move to the downside. You'd rather have it go to the upside, because on the downside, we got a little bit of profitability. On the upside, we have unlimited because we own that underlying stock. So would I rather have Nvidia go up $12 or down $12 if I do this trade? The answer is I'd rather it go up $12 because I have that 100 shares of stock. And this is just that alternative to that trade. So this is going to be our paper trade, billing it as a hedge. I don't want to come out and say that I'm bearish on NVIDIA, but this would be my strategy if I wanted to hedge the market. Now, if you just want to get bullish on it, you can flip the script. I would go exactly the way it is. I do 6 points wide on the call side, and I would target the expected move, which is around $12, and I would do it closer to the close. I would also put this on a little bit closer to the close too, especially considering what's happening with the markets as it's going down at this point in time. I'd probably put this on a little bit closer to the close to protect my portfolio, but the market is going down. So we're down 1.7%, and the VIX is staying strong at 18, and the SPX is almost down 1% at this point in time. So our SPX butterfly is looking pretty good at right now too. So to go along with that. All right, any questions that we have? No. Well, that's going to be it for this edition of Options Guide TV. Thanks for tuning in, and we'll see you this Friday. It should be a very interesting day this Friday, rest of the week. NVIDIA always makes things interesting. So be interesting to hear what they say in the conference call, what companies they'd like to mention, and we'll go from there. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.